We are taught that banks play a simple role in society. They act as a middleman, taking the savings deposited by one neighbor to fund a loan for another. Imagine you walk into your local bank, sit across from the loan officer, and ask for a standard personal loan of $10,000. The officer approving your paperwork never checks the vault for physical cash. They don't transfer a single cent from the accounts of other customers to cover your request. If the bank isn't handing you existing money, where exactly does your $10,000 come from? This chart breaks down the total money supply. Notice the tiny slice, just 3%, that represents physical cash. The remaining 97% is entirely digital. The funds we rely on daily do not come from a government printing press. They are generated through a hidden digital mechanism that most of us completely misunderstand. The transaction begins with a physical action. You read the terms, pick up a pen, and sign your name on the final page. This is a bank balance sheet. The moment the ink dries, the bank records your promise to repay the loan as a brand new asset on their books. At the same time, the bank simply types the loan amount into your digital account balance. In that exact second, your signature brought $10,000 into existence. No funds were moved or transferred from existing accounts. The purchasing power you now hold was born entirely from the legal agreement itself. Your personal signature acts as the ultimate printing press, transforming a human promise into spendable reality. Hundreds of years ago, goldsmiths realized they could issue more paper receipts than they had gold in their vaults, lending out money they didn't have. Private banks now operate with this power as a matter of course. It is a legal, institutionalized standard executed millions of times a day across the globe. There is one critical condition to this process. You are bound to pay back the newly created money, plus an additional fee called interest. Modern banks possess the power to create value from nothing, while placing the entire burden of repayment and risk on the borrower. This shows the math behind your loan. You borrowed $10,000 in principal, but with interest, you now owe $11,000. The bank created the initial principal when you signed, but they never created the extra $1,000 to pay the interest. That extra money does not exist anywhere within the closed financial system. To find those funds and avoid default, someone else must take out a new loan to inject fresh money into the economy that you can then earn. But that new borrower also owes interest that has not been created yet, requiring another person to borrow, creating a never-ending chain. This is why the global economy is forced to constantly expand with new debt. This system operates like a mathematical game of musical chairs, requiring infinite debt expansion just to prevent a total systemic collapse. This constant creation of new money dilutes the existing pool. As a result, each dollar buys slightly less than it did the day before. This historical record shows the real-world impact of that dilution. For everyday citizens, the cost of survival steadily climbs while their income stays the same. Central banks actively manage this by targeting a steady inflation rate. This graph shows the result, a ruler of value that is intentionally shrinking year after year. If the system is designed to shrink the value of the currency, we have to look at who actually benefits from this invisible tax. Consider the world's largest borrowers, national governments. They carry debts so massive they can never truly be repaid through taxes alone. But as the dollar loses its value, the real cost of those old debts evaporates. They borrowed strong money and paid back weak money. Endless inflation functions as a precision-engineered mechanism. It ensures the world's most powerful borrowers see their debts dissolve, while everyday savers are left to quietly absorb